Portfolio Analysis, Lecture 21. Lecture Outline. Hello, welcome to Lecture 21 of Equity Master Secrets. This lecture is called Portfolio Analysis. And what we're going to do in this lecture, we're first going to talk about the need for portfolio analysis and asset allocation. We'll start by talking a bit about what is modern portfolio theory. So there's a standard theory out there that talks about how to create your portfolio and allocate your assets. And then we'll look at some of the problems with modern portfolio theory, in particular why it's flawed. After that, we'll talk about Graham and Buffett's views on portfolio analysis and asset allocation. So in particularly, we'll look at how to select stocks, we'll look at investment risk, we'll look at portfolio diversification, and we'll look at when to sell. And finally, we'll conclude. So this is the last lecture of this course, and this is the lecture where we're going to be focusing on, looking at your investments as a whole. So not just, an individual stock, but how to manage your entire portfolio. Okay, let's get started. Need for portfolio analysis and asset allocation. So in the lecture so far, we have been focusing on evaluating individual stocks based on the strength of their business fundamentals and attractiveness on the valuation. So throughout the entire course, we have been focusing on how to value a company, right? And what are the things we need to look at in order to evaluate a potential investment in a particular stock. So this is, really what constitutes the bulk of the work we need to do when it comes to making investments and when we're doing value investing. So that's why we spent, most of the time on that. But now we're going to move on to a different topic. And the topic we're really going to be interested in now is how do we go about building our investment portfolio? Right, so let's take a look at this equation from the whole, right? We take a step back and we say to ourselves, well, we have all these, companies that we like, right? Maybe we've done some research, we've done our analysis, and we've gone around and we found some companies we want to invest in. And how should we go about building our portfolio, right? How many stocks should we own? Okay, should we own just a couple of stocks? Should we be owning, 20 stocks, 30 stocks? Should we hold the entire index? So that's the first question we're going to answer. The next one is how do we minimize risk? And in particular, when we do portfolio analysis, we often look at the risk of the combined portfolio, right? So it's not just the risk of the individual stock, but we also have the risk of the portfolio as a whole. And this is quite important. And when we look at modern portfolio theory, we'll see what we mean by this. And we also want to think about when should we sell a stock, right? We've obviously talked a lot about how to buy a stock, right? What do we need to find within a company in order to buy that stock? When do we go ahead and sell the stock? And in this lecture, we're going to focus on all of the above factors. And the reason we're going to do this is that we believe it will be helpful in managing your investment portfolio and maximizing the risk-reward equation. So the risk-reward equation is going to tell us that, we want to do our best to increase rewards as much as possible, or potential rewards, and we want to reduce risk, right? And in particular, we want to reduce downside risk, like the risk of losing money. So that's why portfolio analysis is important, okay? And it's always a good idea to take a big picture view when we're doing something like this, right? We're really looking at what should be the size of our whole portfolio and how are we going to allocate these portfolios across different stocks. All right, let's go ahead and get started and look at some of these questions. Need for portfolio analysis and asset allocation. So let's suppose that we're at the stage where we have found a stock, okay, or we found a few stocks, and the stock has the attribute of a great business and is available at a bargain valuation. Right, so we found a stock that we think is a good buy based on our analysis of the company. How much should we invest all the stock, and should we put all our money into this stock? And intuitively, putting all of our eggs in the same basket may seem quite risky, right? So there's no doubt you've heard the phrase before that you should not put all your eggs in one basket, And that essentially means, don't invest everything in a single stock, because something can go wrong and then you would lose everything. And a risk-averse investor, which we all are, a risk-averse investor simply means that we don't like risk, right? So the more risk we have, the worse off we are. So a risk-averse investor may want to spread out his investments across a portfolio of stocks and other assets, so that the risks arising from a single investment would not significantly impact the overall portfolio returns. So our real goal is ultimately to, earn, strong returns over time. And the returns that we care about are the returns on our portfolio, right? Because we may own a collection of stocks and maybe other assets. Some might do well, some will not do so well. But ultimately what we care about is the overall portfolio return, right? That's really what our bottom line is in some way. So if we care about the return on our portfolio, we also care about the risk of our portfolio, right? And the basic idea that we want to think about is, by putting our eggs in different baskets, right? So by spreading our funds across different investments, we could potentially lower the risk of our overall portfolio. And in practice, what this means is that we're trying to maximize our chance of reward. Okay, so we're trying to increase our returns as much as possible, which makes intuitive sense. And at the same time, we're also going to try and minimize the risks. So we're also thinking about, well, what is the return on the portfolio and what is the risk on the portfolio? And we want to make returns as high as possible, and we want to make risk as low as possible. And the way we allocate a portfolio is going to, we're going to have to consider the relationship between the different stocks that we're holding, right? So one concept we'll talk about, is the correlation between stocks, right? And how that might affect the riskiness of your portfolio. What is modern portfolio theory? So now we're going to talk about modern portfolio theory, and we're going to first talk about what it is and how it works. And afterwards, we'll talk about some of the main problems with it. So, modern portfolio theory was pioneered by Harry Markowitz in 1952, and it is an investment framework for the selection and construction of investment portfolios. So, it's really asking the question, how do we go ahead and build an investment portfolio? And the theory is based on the maximization of expected portfolio returns and the simultaneous minimization of investment risk. So that kind of makes intuitive sense, is what we've talked about earlier. We want to maximize the returns, or our potential returns, and at the same time minimize our risk. So modern portfolio theory is essentially based on this premise. And the goal of modern portfolio theory is to construct a portfolio of diverse investments whose collective risk is lower than that of each individual investment. So this is what we also call diversification, right? We put our funds across different assets, and as long as they don't all move at the same time together, then the collective risk of the total portfolio would be less than the risk of each individual investment. So, as per the modern portfolio theory, an investor must not select assets in his investment portfolio based on their individual merits. So this is kind of one of the key tenets of this idea, is that our goal is to understand the portfolio return and the portfolio risk, right? We're not simply worried about the individual merits of the particular investment. So really what we do is that we consider the price behavior of each asset relative to that of every other asset in the portfolio, right? So when we're, let's say, thinking of adding a stock to our portfolio, we're not going to be thinking about the return on that particular stock or the risk of that particular stock. We're going to think about, well, what is the risk of the portfolio once we add that stock, right? So how does the addition of a particular stock change the risk of our portfolio or change the return of our portfolio? So, for example, different types of assets, such as stocks, bonds, and gold, are known to respond differently to different economic cues, right? So you may find, for example, that in times of a crisis, gold might do well, bonds might do well, stocks would do poorly, and in times where there's a boom, stocks might do very well, while bonds and gold not so well. So given that we have this different behavior of these various asset classes, a portfolio that has an optimal mix of different types of assets would bear lower risk than a portfolio consisting of only one type of asset. Right, so the more assets we own, the we're more diversified, our risk is spread out, and because they don't all move together, right? So some assets will go up while others go down. That effectively lowers the risk of our portfolio as compared with only holding a single asset. What is modern portfolio theory? So modern portfolio theory puts forth that investing is a trade-off between risk and expected return. So if we're thinking about the fact that we want to maximize our expected return while at the same time minimizing risk, we can't necessarily do that as without incurring some kind of trade-off. Okay, so typically what we might find is that if we want to increase our expected return, we would have to increase our risk as well. Right, so there's some kind of trade-off. So you can kind of see this, like, let's say if you're comparing investing in the stock market versus investing in a fixed deposit. Okay, the stock market should earn you a higher expected return, right? You're more likely to earn a better return investing in the stock market compared with a fixed deposit. However, you also face more risk with the stock market, right? Whenever you buy a stock, you could lose money, whereas with a fixed deposit, you don't have a risk of loss, right? So if you're comparing a fixed deposit to a stock, the stock has a higher expected return, but also has higher risk. And modern portfolio theory shows us how to build an investment portfolio with an optimal risk expected return equation. Okay, so these are two variables that we're going to look at for each asset, and how do we build a portfolio in order to maximize our expected returns while simultaneously minimizing risk. And at the core, modern portfolio theory is nothing but a mathematical formulation of the concept of diversification. Right, so diversification is the idea that by spreading our funds across different investments, that our overall risk is lower due to the fact that we're diversified, right? Due to the fact that, if one stock goes bad, then, we still have all our other stocks in the portfolio. So our risk is not all concentrated in a single asset. So that's really what modern portfolio is aiming to do, is it's about diversification. And it attempts to show how an investor can achieve the best possible diversification strategy. Right, so with this diversification strategy in mind, what is the best way to go about investing? Right, how do we, achieve the best possible diversification strategy in the context of, maximizing expected return and at the same time minimizing risk? Modern portfolio theory assumptions. So now what we're going to do is we're going to go through some of the key assumptions of modern portfolio theory. And we kind of know now what MPT is going to do, right? What we want it to do. But let's go ahead and look at, what are the assumptions that go behind it. And what we'll find, throughout this lecture, as we talk about these assumptions, is that some of these assumptions are quite flawed, and as a result, this theory is significantly flawed, and we'll talk about that a little bit later in the lecture. So the first assumption is that all investors aim to maximize profit and minimize risk. Okay, and this intuitively should seem quite reasonable, right? We want to increase our returns as much as possible. That makes sense, and we also want to have as little risk as possible. So that also makes sense. So at first glance, this seems quite straightforward. The second one is all investors are risk averse and act rationally. So the first thing, risk averse, well, that also seems pretty reasonable, right? As we said, most of us don't like taking additional risk, and we typically are only willing to take risk if we're going to expect a higher compensation or higher return in the future. So risk aversion is quite reasonable. Act rationally, that maybe is a little bit more questionable. So we've talked about behavioral finance, right, in this course, and we've seen that investors do not necessarily always act rationally. So this may be an assumption that we can, we might question. The correlations between various assets are always fixed and constant. So by correlation, we mean, how does one asset move relative to another, right? So maybe gold has an inverse correlation to the stock market When the market goes up, gold goes down, and vice versa. So obviously correlations do exist between assets, but this assumption is also is questionable too, because correlations do change over time, right? They're not necessarily fixed and constant. And this becomes one of the key problems with modern portfolio theory is having to make one of these assumptions. And we'll see later on why that's the case. The next assumption, the return on assets follow a normal distribution. So the normal distribution is the familiar bell curve, okay? And it essentially is a very common distribution, and it's very easy to analyze and very easy to do mathematical expressions of it. Unfortunately, it's not very applicable to financial assets. So most assets typically do not follow a normal distribution. So this is really an approximation, but maybe not always a good one. And finally, investors have a very clear and precise idea of expected returns. So essentially, when an investor is considering the expected returns on the portfolio, you would know the expected returns of each of the stocks, right? And that's quite important as well, right? Investors know what the expected return on any particular stock is. Modern portfolio theory, risk and expected return. So as we have now seen, modern portfolio theory assumes that all investors are risk averse and they are trying to achieve profit maximization and risk minimization. Okay, and these were the assumptions we said that were pretty reasonable. And where we might find they're not reasonable is in the way MPT actually defines risk. We'll see that a little bit later on. But at first glance, as we said, this seems quite reasonable. And however, the underlying concept behind this is that there is a direct correlation between risk and return, and the theory puts forth that investors are willing to accept more risk for higher payoffs and will accept lower returns for a less risky investment. Okay, so this is essentially saying that in order to induce someone to take on a more risky investment, you have to give them higher expected return, right? So that you have to be compensated for taking on risk, and you get compensated in the form of higher expected return, right? So when we invest, we have this direct correlation between the two of these things. So broadly, there are two important factors that an investor needs to balance and optimize. Okay, and by optimize we mean choosing the stocks to maximize our returns or minimize our risk. So the two factors we want to optimize and balance are the expected portfolio return, right? So we want to make the expected portfolio return as high as possible for a given level of risk. And the second is the portfolio risk, right? So in this case, we can say we want to make the portfolio risk as low as possible for a given expected return. So these are the two variables that are important from the point of view of an individual investor, right? So in modern portfolio theory, it states that the investor cares about these two things, right? The expected portfolio return and the portfolio risk. And what we're going to do now is, look a little bit at how Markowitz, looks at risk and return. Okay, and as we said, this may seem quite reasonable initially, but we may find that actually, given the way these things are defined and how we actually interpret them, it may not be as reasonable in practice. Right, so modern portfolio theory is something that's quite very elegant and very tractable as a theory, but it's a little bit more difficult. It's fairly difficult to implement in practice, simply due to the fact that a lot of things are just not known. Things like correlations and expected returns of every asset, we typically don't know what these are. And in order to apply modern portfolio theory, we need to know what they are. MPT, risk and expected return. So first, let's talk about risk. In the modern portfolio theory, risk is the same as volatility, and this is a measure of the variation of returns of an investment over a period of time. Right, so volatility essentially is the standard deviation, right? And the standard deviation is looking at, well, how much do the actual returns deviate from the mean of the returns, right? So it's kind of like look at deviations from the mean, and the greater the deviations are, the greater the risk is, the greater the volatility is. So this is how MPT looks at risk, but MPT does not look at the risk of an individual investment in isolation. Right, so remember we talked about that what we're trying to do is optimize the whole portfolio, right? We're trying to maximize the return of the portfolio and minimize the risk of the whole portfolio. So what this means in practice is that we consider how each investment contributes to the risk of the aggregate portfolio. Whenever we are evaluating an investment, what we're essentially going to do is look at, well, how does the addition of this stock impact the expected return of my portfolio and the risk of my portfolio, right? So always we need to think of everything in the context of a portfolio. And typically the greater the portfolio volatility, the greater the risk, right? So if a stock increases the portfolio volatility, then we say that the risk has gone up. Now, the second thing we'll look at is the expected return. So the expected return, by expected we mean the average return or the mean return. And typically the way we would calculate this, or the way we would think about this in practice, is that the expected return on an investment is based on the average return it has offered investors over some historical period, right? So if we were to look at, say, a particular stock and what have been its returns over some time, then we might say that this is the expected return, right? This is the average return. This may not always work in practice, this method of giving us the expected return, because sometimes stocks can have very, very strong periods, sometimes weak periods, and depending on the historical period we use, right, we might get very, very different numbers for the expected return. But think of the expected return as being the average return on an investment. And therefore, the risk that we're looking at is the deviation away from expected historical returns during a certain period. Right, so risk in this case is volatility or standard deviation, which is the deviation away from the average return or the expected historical return over a particular time period. Why is modern portfolio theory flawed? So modern portfolio theory seems quite intuitive and seems quite nice and a rich, easy framework to work with, but unfortunately it has some serious flaws. Right, so we talked about the efficient market hypothesis in the previous lecture, and MPT kind of can fall into the same way we look at the efficient markets hypothesis, where we do have some serious flaws with it. And we have to first note that both of these theories have several common assumptions. So firstly, both the theories are based on a simple assumption that risk is defined by volatility. Right, and we said that volatility was looking at the deviation of returns from its mean, right, or from its average. But really, is volatility a good measure of risk? And what we're going to argue that that's actually not the case. So typically, investors are concerned by downside volatility, right? So really, we care about deviations from the mean return, but we only care about downside deviations, right? We care if that returns are going to be less than what we expect. But then, would you call a portfolio that is going up as a risky portfolio, right? So if we have upside returns, so returns above the historical average, that would show up as risk in the modern portfolio theory. But is that really intuitively what we think of as risk? And the answer is no, right? Typically, we don't think of, positive returns, so returns above the mean, as being more risky, right? Typically, that's something that's good. That's something we want. So unfortunately, the measure of risk that we're using, volatility, regards upside and downside movements as equally bad, right? So when we say a portfolio has a higher risk, it's saying that, it's saying that both higher returns can occur on the downside as well as the upside. But in practice, we don't really necessarily want to shy away from upside risk. We typically like upside risk. We don't like downside risk. So a good example is if you were to buy a lottery ticket, right? A lottery ticket, based on modern portfolio theory, would seem very, very risky, right? Because the upside deviation is extremely high if you win. But really, it's actually not risky because the downside prospects is very, very low. The maximum you can lose is a really small amount, right? And upside risk is a good thing. So that's why, you know, volatility is not necessarily a good measure of the actual risk of a portfolio. And typically this is because volatility considers both upside and downside movements as bad, and really as investors we only consider downside movements to be bad. Why is the modern portfolio theory flawed? So the other misconception that the theory suffers from is this assumption that there is a direct relation between risk and return. So we talked about how in order to, you know, get investors to take on a more risky investment, you have to offer them higher return. And that does make intuitive sense, but it's not necessarily the case that this relationship exists in practice. So in reality, high volatility does not necessarily produce better results, nor does low volatility produce poor results. So it's not necessarily the case that stocks that have high volatility tend to give you higher returns, and vice versa. And the other factor is that volatility does not remain constant over time. And this is something that, you know, you can certainly see just by, you know, following the markets on a regular basis, that there are periods when volatility is very high, right? Say during crises or during, you know, high risk aversion times. And then there are periods when volatility is very low, right? And this is a really common feature of markets, and it's something that we need to be aware of. So while MPT's basic idea of diversification is quite reasonable, okay, the idea that you should, you know, invest in different assets to lower your overall risk, it fails miserably when it attempts to theorize it and create a mathematical formulation for portfolio selection. So unfortunately, it doesn't work very well when we actually need to implement it in practice, right? So it's kind of a good, it's good to know and it's good to understand it, because some of the principles are very applicable, like the idea of diversification, which is important, but the exact, you know, application of it is not necessarily very strong. And the philosophical premise behind modern portfolio theory goes in sharp contrast to value investing and behavioral finance. Right, so with value investing, we're typically thinking that we're finding stocks which have, you know, a high potential return, but also have, you know, low risk, right? Because they have a strong margin of safety, for example. Right, so that kind of goes against what MPT tells us. And behavioral finance as well also goes against it, because MPT tells us that all investors are rational. And when we looked at behavioral finance, we saw that this is not necessarily the case. So now what we're going to do is let's understand the views of value investors such as Warren Buffett and Benjamin Graham on aspects such as portfolio selection, risk, diversification, and when to sell. Portfolio management, Graham approach. So first let's look at you know, how does Benjamin Graham understand portfolio management and what can we learn from it. So here's a quote by Benjamin Graham. Mathematics is ordinarily considered as producing precise, dependable results. But in the stock market, the more elaborate and obtuse the mathematics, the more uncertain and speculative the conclusions we draw therefrom. Whenever calculus is brought in, or higher algebra, you can take it as a warning signal that the operator is trying to substitute theory for experience. Benjamin Graham. So what is this quote trying to tell us? It's telling us that you know, using very fancy mathematics and you know, these types of theories, and modern portfolio theory is, you know, involves some fancy mathematics. Whenever we do this, then we typically you know, don't gain anything from it, right? Typically that it's substituting theory for real experience, and it's not the right thing to do. And this above mentioned quote from Benjamin Graham is a good indicator of his philosophy in both stock selection as well as portfolio management. So the way Benjamin Graham selected stocks and created a portfolio was something that was quite simple and straightforward, and did not involve the use of, you know, fairly complex mathematics. So as per him, simple, easy to follow rules are all that one requires in order to beat the markets over the long term. Okay, and you know, beating the markets over the long term is a good benchmark to think about what we're trying to do, right? And this is because typically we can replicate the market performance quite easily, right? We can invest in an ETF, an exchange traded fund, and typically that will, you know, exactly follow the performance of the market index. So we can earn the market return, and that's easy to do. So when we want to do all this analysis and try to find these good stocks, we're typically looking at beating the markets over the long term. And according to Benjamin Graham, there are some simple, easy rules that we can follow in order to accomplish this. So as a result, concepts like the modern portfolio theory, the CAPM, which is the capital asset pricing model, or beta, these are both things that are part of modern portfolio theory. We haven't talked about them in detail, but if you're interested, you can certainly Google them and you'll find a lot of information on it. But these kind of concepts are not found in Benjamin Graham's book, right? These are not things that he considered to be very important. These are all mathematical formulations, and Benjamin Graham, as we can see, was against the idea of using complex mathematics in order to build your portfolio and in order to make your investments. Finally, he firmly believed that the risk to an investor comes not from the volatility in the stock price, but from a permanent loss of capital. So he kind of shared the same definition of risk as us, which is that, risk is about losing money, right? Your loss of capital. It's not about volatility in the stock price. Portfolio management Graham approach. So it turns out that Benjamin Graham was indeed right? When we saw Benjamin Graham's, philosophies on creating a portfolio, it turns out his insights were much more correct than modern portfolio theory. And we just saw that modern portfolio theory has one important assumption at its core. It argues that returns go hand in hand with risk, right? That higher risk means higher returns. And if this was true, high beta, which is a measure of risk, would automatically mean high returns. So beta in the modern portfolio theory looks at the relationship between a particular stock and the market as a whole, right? And the higher the beta is, the higher the riskiness of a stock as compared to the market as a whole. And this theory has been proven wrong on numerous assumptions, right? So typically, according to MPT, we would find that higher betas, meaning with stocks that have greater risk than the market portfolio, should give us higher returns. And we find that in the real world, this is not the case. And one of the really important results in stock market analysis has been that it has historically been observed that growth stocks are the ones with the high betas, right? So growth stocks are stocks with high PE ratios and high price to book value ratios. So it means that there's a lot of growth priced into these stocks, right? Earnings growth. These are also the stocks which have the high betas. But typically they have invariably ended up giving lower returns than low beta value stocks, right? So according to the theory, MPT, we should find that growth stocks outperform because they have higher betas. They should earn the higher returns over time. But in practice, this is not the case. In practice, we actually find that value stocks tend to do better than growth stocks. And value stocks are low beta, and they're not, meaning that they're not as risky as defined by modern portfolio theory, but they still tend to earn us stronger returns. Okay, and this is kind of the key empirical fact that we see that really validates the approach of Benjamin Graham, and really kind of gives us a good justification for why we should expect value investing in order to produce strong returns over time. And thus, the modern portfolio theory is proven wrong, right? If we were to actually take the implications of MPT and look at the stock market data, we would find that modern portfolio theory does not hold. So it's unfortunately not something that we can use in practice, even though it's quite elegant, and it certainly provides us useful insights. Certainly the insight about the importance of diversification is very, very useful, but unfortunately we cannot apply its direct conclusions. Portfolio management Graham approach. So if modern portfolio theory is of little use in constructing a market-beating portfolio, what method should an investor use? So one final thing to mention about MPT is that one of the main conclusions from it is that we can't really beat the market, and that you should invest in the market portfolio to be the most diversified. So by definition, it's not going to tell us how to beat the market. But since that's what we're interested in doing, what method should we use in order to beat the market? And Graham was of the view that trying to exploit the behavioral deficiencies of humans would serve an investor much better in portfolio construction, as well as management than theoretical concepts like modern portfolio theory. So rather than use modern portfolio theory, Graham's approach was to try and identify, the behavioral deficiencies of investors, right? So typically, we saw behavioral finance and common mistakes that investors make. And if we can exploit these deficiencies, then this would lead us to construct a strong portfolio. So he therefore greatly promoted the idea of buying beaten down stocks that are trading at a significant discount to their readily ascertainable intrinsic values, and also ignoring stocks that have a great deal of growth priced into them. So Benjamin Graham was one of the pioneers of value investing. And the basic idea was that you should buy stocks that are considered value stocks, so where they're trading at a significant discount to their intrinsic values. So their intrinsic value, remember, is what we determine its value is, or you can, in some cases, that might be the book value. And price, and when the stock is trading well below this, then we should buy it. And we should, at the same time, avoid stocks that have a great deal of growth priced into them. And growth stocks, as we said, are ones which have high price to earnings ratio and high price to book ratios. And the reason for this is that empirically we do find that value stocks do tend to outperform the market, and growth stocks tend to underperform the market, right? And relative to what the MPT tells us, MPT will tell us that growth stocks should have higher returns than value stocks, but in practice the opposite is true. So this is kind of, one of the big flaws of MPT, and Graham was all about trying to exploiting the fact that, value stocks do tend to do better than growth stocks. So as a result, we should buy stocks that are trading at a discount to intrinsic value, while at the same time ignoring stocks that have a lot of growth priced into them. Portfolio management, Graham approach. Successful portfolio management, then, is not a function of higher order mathematics or calculus as per Graham. So MPT makes use of calculus and fairly advanced mathematics to come up with its conclusions, and according to Graham, we don't need this in order to do successful portfolio management. Instead, it is all about having considerable willpower so that the temptation of following the crowd can be minimized, right? So if the crowd tends to pile into growth stocks, and that's why they become quite expensive, then this is what we need to avoid. What is the number of stocks that one should have in their portfolio? So according to Graham, we need no more than between 20 and 30 stocks in our portfolio. And this is a fairly reasonable number. You can typically achieve, good gains from diversification by holding 20 to 30 stocks. And, so if we're value investors and we're analyzing stocks in quite detail, we typically cannot hold a huge portfolio anyway. And according to Graham, when it comes to selling a stock, the moment a stock reaches its predetermined intrinsic value, it should be sold and replaced by another stock that trades at a huge discount to readily ascertainable intrinsic value. So suppose we go out and we come up with the intrinsic value of the company, okay, and the stock is trading at a discount to it. Once the stock price goes up and reaches its intrinsic value, then we should sell the stock, right? And that's kind of the main approach by Graham when it comes to, how do we invest and then how do we exit as well, right? How do we sell stocks? And we do this whenever a stock reaches its intrinsic value. And if no such opportunities are found, so suppose we do not find another, stock that's trading at a big discount to intrinsic value, then we should simply invest our money in liquid bonds, or in our case maybe fixed deposits, and wait till these opportunities show up again. And to conclude, our view really is that Graham's views on portfolio management make a lot of sense. And after all, how can one produce a superior performance unless one does something different from the rest of the crowd, right? So if we do what everyone else is doing, this is not going to give us the superior performance. Instead, we need to do what we think is best, and we need to do something a little bit different. And this philosophy of Graham's is something different and something that is shown to work and perform above average results over time. And Benjamin Graham has certainly tried to convey this philosophy through his teachings about value investing and portfolio management. So now we've had a chance to look at the Graham approach to portfolio management. For the remainder of this lecture, we're now going to look at the Warren Buffett approach. Portfolio management Buffett approach. So Buffett's investing philosophy has been largely influenced by Graham's idea, right? So we know that Warren Buffett was Graham's student in some sense. He learned a lot from Graham, and his investing philosophy is shaped a lot by what Graham taught, but it also differs in some key ways. So his own investing style focused more on qualitative factors, and we've talked about this earlier in the course, that Warren Buffett also considers things like the quality of the management and the economic moat in order to find good investments. So what is the Buffett way of selecting stocks and building a portfolio? So Warren Buffett focuses on the merits of an individual stock and does not bother about its volatility or correlation with other asset classes. And this is kind of the exact opposite of modern portfolio theory, right? So modern portfolio theory actually ignores an individual stock and really only cares about how it relates to the overall portfolio. Whereas in this case, we're kind of, according to Warren Buffett, we would only focus on the merits of that individual stock, right? We want to know, we want to find stocks that have high returns that are also low risk. And really, the volatility or correlation with other asset classes doesn't matter. So, and this kind of makes sense if you look at what Warren Buffett's approach is, right? Warren Buffett's approach is to buy great businesses with a durable economic moat that are available at attractive valuations, right? So, Warren Buffett's approach is all about finding companies that are expected to perform strongly over time, right? That have these economic moats, which means that they can earn, above average returns for a significant period of time. And if such a company is available at an attractive valuation, right, so at a good price, then we invest in that company, right? So because his style is so focused on, the qualities of an individual company, you can kind of see why, it doesn't really matter, how it, what its volatility is or what its correlation with other asset classes is, right? It's all about that individual company and, finding the best stock based on that individual company perspective, and not really worrying about these, bigger factors like correlations with other asset classes. Portfolio management Buffett approach. So as per Buffett, volatility or price fluctuation is not a risk at all. And we've kind of seen this when we've, earlier, because we saw that volatility it looks at both upside and downside deviations, and really our risk is really about the downside. So on the contrary, according to Buffett, volatility actually gives us great investment opportunities for value investors. So let's see why this is the case. So here's a nice quote that should help to illustrate the point. The stock market is there to serve you and not to instruct you. That's a key to owning a good business and getting rid of the risk that would otherwise exist in the market. So what is the real risk to investing in that case? So Buffett focuses only on business-specific risks. So he only looks at the risk to that individual stock. So going back to our earlier point about volatility, the reason volatility gives us opportunities is because let's say there's a lot of downside volatility, so particular stocks fall significantly, then that gives us opportunities to buy this company at an attractive valuation, right? So the volatility actually provides us with the investment opportunities that we want. And going back to business risks, and Buffett only focuses on business-specific risks, and business risks could arise from various avenues. So one good example, suppose we have a highly leveraged company, then insolvency could be a risk, right? The company could go bankrupt because if it has a lot of leverage, it has a heavy interest burden, and if the cash flows aren't enough to meet this, then this could lead to bankruptcy. Or, for example, take a commodity business, right? A commodity business may suffer because of high competition, right? Because goods are standardized, it may be relatively easy for someone else to enter the market and sell the same product. From an investor's point of view, paying too much for a stock could be a risk, right? So if we pay too much for a stock, then perhaps we are taking an undue risk in that way. So what does Buffett do in order to mitigate risk? So firstly, he invests in businesses that are inherently low risk and do not have too much debt, right? So avoiding this problem of a highly leveraged company. And second is to only buy stocks when the price tag looks attractive. So there's kind of two things we need for two criteria for an investment. One is that this company has strong potential due to its economic moat, and the second is the price tag must be attractive. It must be trading at a fair price that gives us a significant upside. Portfolio management Buffett approach. So the next question is, how many stocks should an investor own and how much should one diversify? So for lay investors who do not have much time to focus on investing, Buffett suggests total diversification. And here he suggests investing in a low-cost index fund. So interestingly, if you look at modern portfolio theory, that also comes to the conclusion that you should simply buy an index fund because it's not possible to beat the market. And this is actually what Buffett recommends in the case where we do not have much time to focus on investing. Right, so if we're not going to be spending lots of time analyzing companies and trying to find good investments, the best thing to do is to diversify completely. The way to do this is to invest in a low-cost index fund. Right, if you can find a fund that replicates the performance of the index, and typically these exchange-traded funds are fairly low cost, their expense ratios, this gives us a decent result and gives us good diversification. However, for avid investors who have confidence in their research, he suggests having a concentrated portfolio of about 5 to 6 stocks. So for those of us who are interested in finding stocks that will beat the market, who want to beat the market and do our research in order to accomplish that, we should have a portfolio that's concentrated of only about 5 to 6 stocks. So as per Buffett, if you have been able to identify great businesses at a fair price, then there is no need for further diversification. So 5 to 6 stocks is quite small, but really, according to Buffett and his investment philosophy, this is not a risky thing because if these are great businesses at attractive valuations, then really you can expect to do very well from these stocks. So instead of trying to find more investment ideas, one should simply invest more in your best investments, and then you will be well rewarded, right? So rather than buy additional stocks that may not be as good in terms of being great businesses at attractive valuations, if you just invest more in the stocks that you found in your best performing investments, then this will give you the best result in the end. So here is a quote. Charlie and I operated mostly with 5 positions. If I were running 50, 100, 200 million, I would have 80% in 5 positions with 25% for the largest. In 1964, I found a position I was willing to go heavier into up to 40%. I told investors they could pull their money out. None did. The position was American Express after the Salad Oil scandal. In 1951, I put the bulk of my net worth into Geico. And here you can see Warren Buffett's philosophy at work, right? To really just focus on finding good investments, and that's what's important. Not to worry too much about, having lots of investments. It's more important to have a few very, very good investments than have, more investments but that are not necessarily as good. Portfolio management Buffett approach. So lastly, the most important question, when should you sell a stock? So we saw this with Graham already, who advocated selling a stock when the price reaches its intrinsic value. Buffett takes a slightly different approach, and he is famous for often emphasizing that his preferred holding period is forever. Right? So this means that he really doesn't have any intention of selling the stock at all. And it means that once he has bought a great business at a good price, he does not bother about where the stock price goes. And as long as the business fundamentals are intact, he prefers holding the stock for a fairly long period of time. So the basic idea is that we don't really have any holding period in mind, and we're going to hold a stock as long as the business fundamentals of this company remain strong. And this means that in practice, he would sell off an investment if he sees the long-term business fundamentals deteriorating. And this can certainly happen because, companies can go through cycles. They can go through periods where they have very strong business fundamentals. And then, because of, environmental changes, industry changes, they can go into decline afterwards. So if a company saw its business fundamentals going into decline, that would be a good time to sell the stock. And it is worth noting that he does not focus much on the stock price movement, right? So Graham's approach said when the stock price moves up towards its intrinsic value, then you should sell. Whereas according to Buffett, it's less about what the stock price is doing, but more about the business fundamentals. And he buys a stock like he is buying a business and follows the same approach when it comes to selling it. So the Buffett approach is to really think of stocks as actually buying into a business, right? And the same approach when you're selling it. In some cases, he would consider selling when stock valuations are way overstretched. So it's not just to say that he completely ignores the stock price, but if it is the case that stock prices are extremely high, right? So valuations are very overstretched, then we would consider selling the stock. And here's another quote by Warren Buffett. If you own great businesses, you should just hold on most of the time. Maybe sell if the valuations get extremely high and buy more if they get really cheap. So the key is to identify a great business, right? And then, in general, we should be holding on to it most of the time and only consider selling if valuations get very high. And one thing we can also do is that if valuations get low, then this gives us a good opportunity to buy more. Right, provided we're still confident that the strong business fundamentals apply. Conclusion. So this now brings us to the conclusion of this lecture. In this lecture, we discussed the modern portfolio theory and the concept of diversification. And despite being a sophisticated mathematical formulation, MPT is based on the flawed premise that risk arises from volatility. So once we looked at MPT and we looked at some of the flaws of MPT, we then studied Graham and Buffett's views on stock selection, investment risk, portfolio diversification, and when to sell stocks. So with this, we come to the end of our value investing course on Equity Master Secrets. And firstly, I would just like to say, I'm feel very privileged to have delivered this course to you. I thoroughly enjoyed it, and I thank you all very much for taking part and listening, and I hope you got a lot out of it, and hopefully you will go on and go ahead and find some great value stocks to invest in. And we're going to now end the course, and before we do that, we will leave you with one of Buffett's famous quotes, which very aptly lays down the roadmap that we would like you to pursue hereafter. You should approach investing like you have a punch card with 20 punch-outs, one for each trade in your life. I think people would be better off if they had only 10 opportunities to buy stocks throughout their lifetime. You know what would happen? They would make sure that each buy was a good one. They would do lots and lots of research before they made the buy. So hopefully that quote would leave you with, the inspiration to go ahead and do research and find good stocks. And though we have finished this course on value investing, this is certainly not the end of one's education on the topic. You also learn a lot from just going out and doing it. Certainly, the more experienced you get at it, the more companies you analyze, the easier it becomes and the better you get at it. So you can certainly learn a lot more. You can always keep learning. I'm always learning more about how to invest. So I would certainly encourage you to do the same. So once again, thank you very much. It's been my pleasure to deliver this course to you. And on behalf of the Equity Master Research team, we really thank you for taking part and hope you gained a lot out of this. Okay, thank you very much and goodbye.